Mortgage companies are failing. Hey, everybody, you're watching Bull, Boom, Bear, Bust. We're going to give you the latest in the housing bubble saga, where now mortgage companies are failing. Now, we reported on this a few weeks ago. We've got some important updates for you on this and how this may impact the overall broad housing market. Let's go ahead and get started. Now, a recent article here out of Bloomberg highlights this pretty well. U.S. mortgage lenders are starting to go broke. After the crisis, banks account for less of the mortgage business. What that means is these are non-bank lenders that are starting to go broke, starting to file bankruptcy. Non-bank lenders, examples would be Quicken and others that aren't banks. Banks, of course, Bank of America, Wells Fargo, etc. They are not going broke, but the non-bank lenders, some of them are starting to go broke. These non-bank lenders, also known as independent mortgage lenders. Now, let's go over a little more out of this article, and then I'll give you my take on it. The U.S. mortgage industry is seeing its first lenders go out of business after a sudden spike in lending rates. And a wave of failures that's coming could be the worst since the housing bubble burst about 15 years ago. Now, I think it's going to be much worse. Why? Because the non-bank lenders have taken up much more of the mortgage market now versus before the housing bubble went bust back in 2008. In fact, it's a lot more now. Let's take a look at this. As of 2020, non-bank lenders were already dominating the mortgage market. In fact, non-banks issued more than 2/3 of the mortgages in 2020. That was the highest market share on record. Now, this is a big change from 2008 when we saw only about 1/3 of mortgage originations coming from non-bank lenders, lenders like Quicken Loans. Now, why are these non-bank lenders going bankrupt or failing and the big banks are not? Well, the big banks have deposits, right? So these non-bank lenders, they don't take deposits. They don't have checking accounts and savings accounts. And therefore, they're not considered as systemically important as these non-bank lenders. These non-bank lenders, it was only a matter of time before they failed with an uptick in mortgage rates. And now with the Fed reducing their balance sheet, they don't have any place to sell these loans. And now that these loans are losing value, in other words, home prices coming down, the value of these loans is now going to be not very enticing to an investor. And we know the biggest investor out there, the biggest buyer of these was the Fed. Now the Fed is no longer buying as much as they used to. And other investors don't want to touch these. These are bundles of loans that they package up and place into securities and sell off in the bond market. Other investors don't want to touch these because the value, the underlying asset values are weakening, softening, and going down in many markets, especially San Francisco and some of the other high-flying housing markets where home prices are coming down. So, of course, investors don't want this. The Fed is reducing their balance sheet. They're not going to be there to save these banks. I think this is just the first of many non-bank lenders to fail. Now, what are the other implications? Some of the other implications for this? Well, there's going to be less options for home buyers and also job losses, right? Hundreds of people now losing their jobs at these lenders. And that's going to be more people looking for jobs in other places. One, will they be able to find jobs? Two, will the jobs that they find, if they find a job, will they be enough pay to keep up with the current cost of living, right? So all of this is just another piece of the big puzzle here of this current economic decline that we're headed into. Right? When bubbles are created, when they're blown up, when home prices are on the rise, that creates jobs. It creates demand. It creates more spending. People are remodeling these homes. Flippers are buying furniture and upgrades and materials. And that also creates jobs because they're hiring contractors. And it's basically a snowball effect. So when it goes up in a big way. And housing has such a huge impact on the economy. Now with the reverse happening, we're going to see more stories like this. Non-lending banks going bankrupt. Technically, the too big to fail banks would go bankrupt if it weren't for the infinite bailouts that are offered to these too big to fail financial institutions. Now, this is definitely not contained to just the United States. We see banks across the globe and mortgage lenders are failing. Look at China. China banks may face $350 billion in losses from property crisis. Now, we say may, or they say may. Bloomberg's reporting this because they could get bailed out. We don't know yet which companies are going to be rescued, which are going to be allowed to fail. But we know in America, we are starting to see non-bank lenders failing and not being rescued, going through bankruptcy. Also in China, they have mortgage boycotts going on because of the home prices and the wages. Will we see any sort of thing like that here in America as far as mortgage boycotts? I highly doubt it. I highly doubt it. Now, Nancy Wallace is out there. She is the chair of the real estate group at Berkeley. She says, quote, "The non-banks are poorly capitalized," unquote. Well, yes, that's definitely true. In fact, non-banks have to get credit or take out a loan to begin operating, and then they make their money from fees, all those fees they charge you for your mortgage. There's, of course, a ton of fees, but some of them actually go to the lending institution and these non-banks for the banks. And basically, she sums it up right here, quote, "When the mortgage market tanks, they are in trouble." So these non-bank lenders, they rely on ever increasing home prices. As soon as the Ponzi scheme has a hiccup, or as soon as the Ponzi scheme takes a pause or home prices come down, you see that's not supposed to happen in this type of lending. You have to have ever increasing home prices. Otherwise, the whole thing fails. And don't feel too sorry for the people at the top. The CEOs, the high upper level executives, they're walking away with golden parachutes. They've already made their millions, and some of them probably even have yachts, if I had to guess. It's the employees that are going to be facing hard times. Now they're losing their job, and they're going to go out to a very high cost of living out there with not many job opportunities in banking like they were that's going to pay enough, especially when we see so many layoffs now in real estate, in the mortgage industry. Also, we have home sales crashing faster now than before the bursting of the previous housing bubble. So let's add all this up here. We have the population, consumers in record levels of debt, even more leverage now than before the previous housing bubble went bust. We've got unaffordability at all-time highs, much worse than it was before the previous housing bubble went bust. We've got non-bank lenders starting to fail, and therefore less mortgage options for people that are looking for a mortgage. We've got the cost of living way beyond what we saw before the previous housing bubble. So if people couldn't afford homes back then, the cost of living is much higher now. The home prices are higher now. Unaffordability is higher now. This is a recipe for a big fallout in the housing market. Now, I still don't think it's going to crash because all of the intervention and rescue programs that we're going to see, but it's definitely going to be interesting to see how far and how quick prices will fall from here. Please let me know what you think down in comments about these failed mortgage lenders, these non-bank lenders, and what you see ahead for this housing market. And here's just a few of the things I expect. More price declines, delinquencies and foreclosures rising, more job losses as contagion worsens. What happens in the housing market spreads to the rest of the economy, and these people may go out and find another job, these people that got laid off from these mortgage lenders, but will it be in fast food? Will it be in hospitality and leisure? Some other much lower paying job? And how are these jobs going to translate into trying to make it by in this economy where other costs of living are still high and going higher? Please let me know what you think down in the comments. Thanks for watching this update, everybody. Be well. Bye for now. Keep stacking. Peace.